In this video, Michael Saylor will explain what inflation actually is and how you can protect yourself from it.
Assets can't be inflated.
What's an asset?
A house, a share of Apple stock, a bond, a Bitcoin is an asset, or a Picasso painting. So,
Not a consumable good. Not an apple that you can eat.
right. If I throw away an asset, then I'm not on the hook to track the inflation rate for it. So what happens if I change the policy such that, let's take the classic example, $1 million bond at a 5% interest rate gives you $50,000 a year in risk-free income. The cost of Social Security went from $1 million to $10 million. So if you wanted to work your entire life, save money, and then retire risk-free and live happily ever after on a $50,000 salary, living on a beach in Mexico, wherever you wanted to go, you had hyperinflation. The cost of your aspiration increased by a factor of 10 over the course of, some amount of time. In fact, in that case, that was like over the course of about 12 years, right? As the inflation rate ground down, the asset traded up. But the conventional view is, oh, that's not a problem because it's good that it's good that the bond is highly priced because we own the bond. Or what's the problem with the inflation rate in housing being 19%? It's an awful problem for a 22-year-old that's starting their first job, that's saving money to buy a house. But it would be characterized as a benefit to society by a conventional economist who would say, well, housing asset values are higher because of interest rate fluctuation, and now the economy's got more wealth. And so that's viewed as a benefit.
So cool. So we've got inflation as sort of problem number one. You often use the analogy of, if you have a boat that has a leak in it, you've got a real problem. And if you know that inflation at some level exists, you've already got a problem. So when did you begin to think, okay, I've got this? In fact, what I'm really, the part that I find so intriguing about your story is when you turned to Wall Street and were like, I have a profitable company. It is wildly profitable. And yet Wall Street does not like it. Dear Wall Street, why do you not like my company? And the answer to this is so revealing.
Yeah, the company was valued at like 1 times revenue plus cash. And I said, well, I have $500 million in cash. Why don't we get more credit? And the answer is cash is trash. It's Ray Dalio's quote, cash is trash. Well, why is cash trash? Well, if the money supply is expanding at 7% a year, then the risk-free hurdle rate is 7%. If you don't generate more than 7% yield on your cash, then it's devaluing. So from 2010 to 2020, the money supply expanded at 7%. So all the cash you're holding is losing 7% of its value, assuming you have a 0% interest rate or zero yield on the cash. So you can imagine the traditional world, you invest your cash at 3% treasury yields and you get a -7 and it's like a -4% and divide 4 into 72. And somewhere 15, 20 years out, you're going to lose half of the shareholder value in the treasury. If you do that, people might hold their nose. But after March of 2000, the money supply is expanding at 24%. The interest rate's 0. So now you have to put a forecast in place. At what rate will the money supply expand? If it expands at 20% a year and you're going to generate 0 in treasury yield, then you're looking at cutting your treasury purchasing power in half in 3.5 years.
Whoa.
Okay, now that's not trivial. So you have to find a way if you're gonna have assets to get over the hurdle rate. Another way to say it is, I have to invest it in a strategy which is going to appreciate faster than the money is devalued. I started going down this rabbit hole of thinking about what is money when I realized that I was in essence going to lose my company, right? And destroy the livelihoods of all my employees and, waste 30 years of my life. And so when I started thinking about it, and, it's helpful when Jerome Powell says we're not even thinking about raising interest rates, your strategy of investing in bonds is broken. When I started thinking about it, what I realized is Money is energy. Money is economic energy, socio-political energy. Currency is a medium through which the energy moves. If you wish to hold energy and transport energy, you need a technology. We're not using gold anymore. When we use gold, as I pointed out, it's expensive and it's cumbersome. Currencies don't work. The U.S. dollar is the strongest currency in the world, but is losing 15 to 20% of its value a year. The peso is losing 40 to 50% of its value a year. The bolivar is losing 100%, 98% of its value a year. So once you start thinking about it that way, you start thinking, well, what's a better way to store economic energy through time? And you realize that the currencies don't work, gold doesn't work. So what is money? Well, money in the last 30 years became the S&P index. You buy a diversified portfolio of companies, of stocks, which is a little bit better because maybe you're getting bled 2% a year by the management team, but the company's making money, and so maybe you can hold value. It turns out that the money's losing about 10% of its value a year, and the S&P index is going up about 10% a year. And you look at that for 100 years, and there's a very interesting correlation there. A diversified portfolio of assets is tracking the money supply. Okay, interesting. What's the problem with that? Well, the problem with holding stocks as a store of value is if the stock goes up by a factor of 10, there's a management team that has a fiduciary obligation to issue more stock. There's a temptation to issue stock. Stocks aren't scarce. The amount of equity shares will also go up. If the stock is overvalued versus the fundamentals of the company, the CEO is almost certainly going to issue more stock. And so that's one problem. The second problem is stocks have political nexus. They have management teams. They're in countries. They can be unionized. I can put a tariff on the product. I've got a competitor. What if the CEO goes bonkers? All sorts of interesting problems. What if the company gets expropriated by the government, or the jurisdiction it operates within? So stocks are an imperfect approach, better than gold. The other approach is buy a bunch of buildings in New York City, buy scarce, desirable real estate in Miami, Los Angeles, London. That's an interesting idea, and the best idea in the 20th century, if you're going to try to either create wealth or hold your wealth. If you want to hold your wealth, you buy $1 billion worth of property. If you want to create wealth, you borrow $1 billion, and you buy $1 billion of property, and you start with $1 million of equity, a sliver of equity. And what you're doing is you're going short the currency, and you're going long the property. So if I told you, let's go to Argentina. If I told you in Argentina the peso is going to go from 1 peso to the dollar, to 5 pesos to the dollar, to 10 pesos to the dollar, to 20 pesos to the dollar, to 40, to 80, to 100, the black market rate right now is 210 pesos to the dollar, 220. If I told you it was going to collapse from 1 to 220, and you had 20 years of notice, what's your best strategy? Take your million pesos, convert it to dollars, and you're going to have 220 million pesos in 20 years. You're going to look rich. Better strategy is borrow 1 million pesos, convert it to dollars.
Wow.
Best strategy would be mortgage your entire company in pesos, sell equity in your company in pesos, convert it all to dollars, and then get the dollars out of the country. Because if they're in the country, if the million pesos is converted to dollars in a bank in Argentina, then the government will basically pass a law, force your dollars to be converted back into pesos, devalue them. And I happen to have some experience with that because I actually had $1 million in Argentina during the last currency collapse. They converted it to pesos. They devalued it 10 to 1. A day later, I'd lost 90% of my money. So, simple idea. Short the currency which is collapsing, go long property, and then get the property out of the country. Because the property in the country is also going to devalue because the property is valued based upon the stream of cash flows, right? If the building has got a rentor and it's got a lease, and the lease is capped at CPI or denominated in local currency, when the currency collapses, the value of the rental income also collapses. So wouldn't it be great if I could buy a virtual building in Argentina using borrowed pesos, and then what if I could spirit the building out of the country and rent it to people in London or New York City? That's what Bitcoin is. Bitcoin is digital property that you can teleport anywhere in space instantly. And it's also perfected property with the lowest maintenance cost. You know, you don't have the property tax you have on a building. You don't have to repaint the thing every 10 years. You don't have to worry about leaks in the roof. So if I could buy $1 billion worth of property and it was in cyberspace, and if you couldn't make any more of it, if I capped it at 21 million city blocks in cyberspace, and if I could hold it for 1,000 years, I might have a better idea than buying a city block in Manhattan or a building in London or even a company. And it's a lot better idea than buying 30,000 pounds worth of gold. Why? Because real estate developers are going to create more buildings, gold miners are going to create more gold, mayors are going to pass a property tax, and they're going to put some kind of enjoinder or some kind of restriction on your rents. Rent control your building. Something, you know, acts of God are going to create earthquakes and floods and lightning strikes. And none of that stuff's happening in cyberspace. So the whole idea of Bitcoin is it's perfected, engineered gold, crypto gold, with none of the defects of gold. You can't mine any more of it. It's weightless. I can move it at the speed of light. It never decomposes. I can break it into 1,000 pieces in a second, send it to 1,000 places, and recompose it. All using a computer program, and I can take personal custody of it. Maybe the most powerful two ideas are, I can hold possession of $1 billion of Bitcoin in my head, just holding a password or a set of private keys. That's a pretty big idea. Maybe the first time in the history of the human race that you can actually take possession of your wealth and take it to the grave with you, or take it anywhere else on earth with you. And even if I put a gun to your head, the most I can do is kill you. I can't take it. Mm-hmm. And this is a very interesting idea. Every other form of property in the history of the human race, I pull the gun, I get it all. If we had sound money, the dollar wouldn't collapse. But you've probably seen this chart. This is the dollar collapsing against consumer goods. Consumer goods, you know, the dollar is 95% weaker. Means consumer goods are 20 times more expensive today than 100 years ago. Now, consumer goods are manufactured items, candy bars, bottles of water, Netflix videos. They're things that are coming off an assembly line and they're getting stamped out with a low variable cost. This is the cheapest, least scarce stuff in this civilization, and yet it's 20 times more expensive. Now, a lot of times, government officials show you this chart and they say, well, this is the impact of inflation. This, in fact, was generated by the Bureau of Labor Statistics. But the sad fact of the matter is, this is as good as it's ever going to get for you. This is a different picture. What if it wasn't easy to stamp out manufactured biscuits or Netflix videos? What if you had to do work to dig the gold out of the ground? Gold is a bit harder. And so the dollar has collapsed 99% against gold in that same 100 years, not 95%. By the way, gold is not scarce. We keep creating more gold. We get better at it, but at the end of the day, you know, it's a bit more scarce than, you know, Netflix videos, and it's a bit more scarce than drywall. Let's talk about something that's even more scarce. The 500 most valuable companies in the S&P. The US dollar has lost 99.8% of its value against the S&P index over that same 100 years. That is actually a closer measure to the inflation rate. This is the world's strongest currency. This is the currency backed by the country that won every war in the last 100 years. This is as good as it's going to get for you. This is as good as it gets. It will get worse. Now, how do you measure inflation? If I measure inflation against something I can manufacture for free, inflation doesn't look that high. If I measure inflation against a yardstick that is fixed, that's thermodynamically sound, then you see the true measure of inflation. S&P is one example of that. This is Miami Beach. Miami Beach runs 96 blocks. There's that much beach. 100 years ago, there was that much beach. No amount of semiconductor technology or factories make more beach. The dollar has fallen 99.8% against the beach in 100 years. That's how you start to see what's really going on with the world's strongest currency. Now I have some bad news for you. We're not in America. We're in another country. Foreign currencies are collapsing against the dollar. This is the Argentine peso against the dollar. In 20 years, the peso goes from 1 to 500. The peso's lost 99.8% of its value against the dollar at the same time that the dollar's lost 75% of its value against the S&P index. I'll let you do the math. If you run a company in Argentina and you're going to work hard, you're going to have to grow your revenues from 1 million pesos to 500 million pesos over 20 years to stand still. And that's why I say no amount of hard work is going to solve the problem of being on the wrong side of an economic war. There's only one strategy here. You have to get out of that peso. You have to exit. This is the lira. This is before this week. It lost 95% of its value. Now the number is about 97% of its value against the dollar. This is the rupee. It's lost 90% of its value against the dollar. So that 99.8% loss is another 90%. So we're kind of running out of numbers to calculate just how much of your wealth has gone from you to the government. When the government actually collapses the currency 99.9%, what it means is over 100 years, they in essence take all of your wealth and they redistribute it to their cronies, to whoever they want. And that's the rate at which it's going. This is Pakistan, 82% against the dollar. This is the Brazilian real, 65% against the dollar. Conclusion. If you want to preserve your wealth, you have to convert that currency into an asset that's scarce, desirable, portable, durable, and maintainable. Right? There are certain things that are scarce and desirable, but they don't move, like beachfront property. And by the way, maintainable, if you own $1 million of property in Miami, you have to pay $20,000 a year, every year, to maintain it, and it gets assessed up. So you have to have $1 million to cover the taxes on $1 million of property in Miami Beach over about 20 years. You can't maintain it. So you're going to be a smart investor. Here's smart investors, people bragging about making money in the stock market. The S&P index is going up 7 to 8% a year. And so you must be really smart. You invested in companies that are making good decisions. Look at the money supply. The money supply is going up at the same rate as the S&P index. And so what you begin to realize is most investment gains aren't really gains at all. All you're doing is simply tracking the monetary inflation rate if you're lucky.
If you got some value out of this content, then please subscribe to this channel and like. this video. And if you want to see another video about that, up here is another one that you can watch.